Global geopolitical risk. Note that the written blog on this subject has multiple links to the reference material that I mentioned in this video. The easiest way to protect your portfolio from geopolitical risk is to not invest internationally. This is not to say you shouldn't reap the rewards of international growth. It is to say, let U.S. companies that you invest in do the international investing. As much as 60% of U.S. firm revenue comes from outside the United States. U.S. geography, as well as regulatory structure, gives us economic advantages over every other economy in the world. In the accidental superpower, Peter Zion makes an all-important observation. Our ability to trade with European and Asian trading partners is almost effortlessly is a key factor in our economic superpower status. Should Europe go into recession, we can easily pivot to working with our Asian partners. All must go into recession for us to do the same. In terms of regulatory structure, we cannot ignore the policing role our regulatory agencies play in our safety as investors. U.S. companies have to go through rigorous reviews with regulators. The United States is second to none in terms of creating the most financial regulatory agencies. Between the Federal Reserve, the Securities and Exchange Commission, the Commodity Futures Trading Commission, and the Financial Crimes Enforcement Network, and a host of others, the financial regulatory regime in the United States towers over regimes in the United Kingdom, Canada, and many other developed companies. And let's not forget that European companies generally report their earnings only twice a year, while publicly traded U.S. companies are required to report earnings quarterly. Far more public disclosure. Another factor contributing to the U.S. stock superiority is the wide variety of media outlets covering the investment and securities business. News outlets like the Wall Street Journal, Bloomberg, CNBC, and Barron's have in-depth reporting, analysis, and market data. Also, outlets like Investopedia and many other online sources provide information. Well, you ask, will avoiding international investing hurt your performance? In a word, no. The graphics that are referenced in the written blog can be maneuvered to show different time horizons, but it clearly shows the superiority of U.S. companies. Why is this? Well, here's a comparison of the companies in the different stock market indexes. Notice that the top U.S. companies fit the IT and communication services profile. These are the fastest growing companies in the fastest growing sector in the world right now. A much discussed topic these days is tariffs. In 2018, there were a series of tariffs put into place with China. This may serve as a test on any further and future tariff circumstances. Oddly, you look at the best and worst performing sectors during this period, and they may surprise you. Research into this will show that there are so many other factors affecting stock prices, it is impossible to separate out the effects of one single factor. Relating to this is currency risk. The US dollar is the reserve currency of the world and the most stable currency in the world. Finally, US-based companies spend time and resources to manage their risks of operating in questionable countries. Former Secretary of State Condoleezza Rice, who like many others has set up consulting practices with both global political leaders as well as Fortune 500 CEOs, notes in her book, Political Risk, that most global companies have their own departments who spend all their time weighing the risk and reward factors of both buying and selling goods in other countries. They constantly judge political and therefore currency risks of their global enterprises. So the best way to invest globally while avoiding geopolitical risk is to invest in large U.S. companies. Thank you.